Hello, today I'm going to be talking about the case Morello versus the IRS, and it was settled in the 11th Court of Appeals. So this first went to tax court, then it went to the Court of Appeals, and this is a case about an S Corp owner who had an S Corp, and then he also had several other flow-through entities, and he used the other flow-through entities to pay expenses of the S Corp in question, the company that the case was about, and he wanted to claim what we call tax basis in the S Corp in question for the expenses that were paid by his affiliated entities, and the IRS didn't agree with that, the tax court didn't agree with that, and now the 11th Court of Appeals has not agreed with that. So to sum that up in a nutshell, the result of the Court of Appeals decision is that payment of S Corp's expenses by affiliated companies isn't going to increase a shareholder's basis in that S Corporation. So to give you a little more flavor for what's going on, just a quick review: S Corporation shareholders can only deduct their flow-through losses to the extent that they have basis in stock or debt. And debt basis, which is what would probably be used in this kind of situation, has to be directly from a shareholder. In other words, the shareholder has to make a direct loan to the S Corporation in order to have debt basis that will allow for the deduction of losses. The other piece of that I think is important to know is that you're not going to be deducting losses against debt basis until you've already exhausted stock basis generally. So presumably you don't have any stock basis left, and so now you've loaned money to the S Corporation. You're trying to deduct losses by virtue of the loans you've directly made to the S Corporation. So it's been previously held that it was already previously held in other court cases that simply having expenses or loans, actually more specifically having loans made from an affiliated entity that somebody owns to their S Corporation doesn't give the shareholder doesn't really give the shareholder debt basis. And the reason for that is because advancing funds from one of your related party entities to your S Corporation isn't considered by the IRS or the courts as a direct loan from the shareholder to the S Corporation. Now, one thing that could potentially give hope in this area of planning was the Treasury regulations, which does say that back-to-back indebtedness is okay. The concept of back-to-back indebtedness is that as a shareholder, the individual person, the natural person, you take out a loan from somewhere, and it could be from your related party entity or some other entity that you own, or it could be from a bank or from a relative or whatever, but you get a loan from somewhere, and then you turn around and provide a bona fide loan to the S Corporation. I think one of the big things that's underlying all of this is that documenting these transactions and not just doing them in an ad hoc basis is critically important to establishing what the fact was of the transactions that would give you basis, as opposed to just trying to say that you're economically similar to that. And that's exactly the problem in this case. The taxpayer, or the shareholder Morello, had other flow-through entities that were paying expenses on behalf of his S Corporation, which we'll call Merco. And some of those other affiliated flow-throughs, partnerships, and S Corporations he didn't even own 100% of, and yet they were paying the expenses on behalf of Merco, which is an interesting side note of this whole thing. So Morello, the shareholder, he claimed that this activity of having his affiliated entities, which he didn't own 100% of, pay the expenses of Merco as S Corporation, was economically equivalent, that in substance it was the same as him giving a back-to-back loan, and therefore he should be covered under the Treasury regulation that would give him debt basis and allow him to deduct more losses on his tax return from Merco. Well, the tax court and later the Court of Appeals had disagreed with that point. They don't believe that is the same as a back-to-back loan. And one of the statements they made is that really we shouldn't be jumping to trying to make economic arguments about substance unless it's otherwise kind of a gray area. But this isn't, to them, as they pointed out, this isn't really a gray area. And if you wanted this to be a back-to-back loan, you could have set it up that way more specifically to begin with, not just relied on us concluding that the substance was the same, essentially. And one of the things that the taxpayer did is they had their accountant there, or who knows, maybe their accountant came up with this idea, but in any case, the taxpayer's accountant made entries at the end of the year which would take the intercompany AR, accounts receivable, and AP between the various entities and Merco, the S corporation, and it would net it all down. And generally then it would come out to a net amount that Merco owed everybody else. So it would have like a net accounts payable. So once you net what was owed to Merco with what Merco owed, it was clear that Merco was the one that owed. So they would net this all down, and then they would book that remaining amount owed. They would put it into the general ledger in the accounting system as if it were a shareholder loan. So they would just reclassify it through an entry at year end, presumably, to shareholder loan. And they thought, the taxpayer thought, and the accountant thought, well, this supports the theory that this is economically equivalent, or in substance just the shareholder making a loan to the S corporation, and therefore we should get basis. But the courts disagreed. They said, you know, your year-end accounting entries don't really cut it. That doesn't really make it so that you actually had back-to-back loans. And so then the second thing they did is they said, well, you know, in courts there's this doctrine that we call the incorporated pocketbook theory. In other words, what the taxpayer, the shareholders, other affiliated companies, their bank accounts are essentially the bank account of the shareholder, that he's just basically incorporated his life into these various LLCs and various other companies, but those are really his bank accounts, and therefore whatever they do should be considered the same as what he does. So the fact that they paid expenses on behalf of Merco, the S corporation, means that he paid those expenses, and therefore he did make a direct loan. And so he's using this incorporated pocketbook theory. Now what's interesting about the incorporated pocketbook theory is that it's kind of like not a great thing to claim in other regards, right? Because it means that you're not really operating your entities as separate entities. So it's an interesting way to try to get to the conclusion that you want, right? But in that, the court disagreed with that as well. They pointed out what we've said several times here so far, that, well, you didn't even own 100% of these entities, and there's really no evidence that you otherwise. I mean, you did keep separate accounting for them. It appears you did operate them as separate entities, as you should. And therefore, you know, there's really no evidence that they are just an incorporated pocketbook for you as an individual shareholder. So we don't buy into that either. What's our recommendation here? Well, our recommendation coming out of this case is, you know, don't be lazy about how you're dealing with your cash flows between the entities here, right? I mean, really what could happen here, what you could do to try to put more belts and suspenders on this and hopefully would have avoided this conclusion by the IRS and the tax court, is if you knew that your S Corp, in this case Merco, was going to need additional funding to pay for expenses, rather than just paying them willy-nilly out of other entities that you own or that you have influence over, entities you don't even fully own but you just happen to have influence over apparently, instead of doing it that way, actually have those entities give you as the shareholder a loan and document it with a note and treat it like a real loan. It has to have interest, it has to have terms, all of that, right? And then take that money and make a loan directly to your S corporation. In this case, that would be to Merco, the S corporation, and document that loan with a note, a contract, interest, terms, all of that. Then you would have a bona fide back-to-back loan scenario, which would have given you the basis that you need in order to deduct your expenses. So it's, you know, I don't want to razz on this particular taxpayer because this is pretty rampant. I mean, this kind of behavior of just like, just managing the cash flows kind of haphazardly and then trying to tell a story about what was happening with the cash flows based on economic substance afterwards. And what this court case tells us is that's a no-go, that you need to actually manage them structurally properly to begin with if you want the tax result of creating debt basis in your S corporation that you can then deduct losses. Okay, that's it for now. Take care, and I'll see you next time.